Okay, so for today's topic, the focus will be to understand the financial statements. So that means first of all, we are going to look into the income statement and to understand balance sheet. And then after that, we are going to understand some formulas in which we are going to apply in our questions. So the contents for today's class will be mostly for your midterm. Okay, so therefore, as usual, we will go through the contents first and then proceed with the tutorial questions. So first of all, what I need you to understand is the income statement. So you need to know what are the components that you have in the income statement itself. Okay, so first of all, we have net sales. So once you have the net sales, we minus the cost of goods sold. All right, and then after that, we minus depreciation. And then after that, this is what we call as EBIT, earning before interest and tax. Okay, EBIT. Now, once you have EBIT, you minus your interest expense. Okay, you get your taxable income. Now, you use your taxable income minus the taxes because we have to pay taxes for the income that we earn. Okay, so it's subject to tax. So therefore, we have to minus the taxation and then we get our net income, which is the final values, okay, that we get from income statement. Now, I want you to remember one thing. Once a company earns a net income, it can be used for two purposes. One is to either to pump it back to the business. Second is to give it in the form of dividends. Okay, so that's very important formula that you must know in the beginning of today's class. So once the company generates the net income, okay, it can be used to pay out as a dividends or it can be used to pump it back to the business. So we can see that the first formula I want you to remember is net income equals to dividends plus addition to retained earnings. So today we have a lot of formulas that you need to remember. Okay, now some formulas may be provided in the midterms, but some may not. So you may want to remember it as your muscle memory. Okay, so therefore, once you get this net income over here, this is the value. So therefore, I can use this value to either to pay it out as a form of dividends to shareholders or to pump it back to the business. So therefore, when I look into these two bottoms over here, the two values add up together, okay, will give me the same value, which is 412. So that is the first formula I want you all to remember. Net income equals to dividends plus addition to retained earnings. Why is that so? Because once we generate the income, we can use it for these two purposes. That's the first formula that we can derive from the income statement. Okay, so you need to understand the components of income statement. So in exam, they might give a scenario. Let's say the company's manager is looking into the net sales, wanted to find out the EBIT, earning before interest and tax. Then you know that the statement that he need to refer to is income statement. Okay, so you see, every year we have different values for the income statement. Like for example, this one is 2008, and then next year we have 2009, 2010, and so on, right? So sometimes, right, when you want to compare across different years, when you look into it in terms of value, sometimes it can be very misleading. Why? Because like for example, you see net sales for 2008 is 1005, right? 1005 here. And next year, maybe the net sales is 2000, for instance. So sometimes, right, when you have, let's say, for example, in 2008, your cost of goods sold is 750. Okay, maybe the next year, you are selling more of your sales, so your cost of goods sold are even higher. So you see, every year, the values are so different that could be misleading. So one way to make it simplify is to convert everything into percentage when you want to compare across different years. So therefore, one way is like we call it as a common size income statement. That means that we convert everything to percentage. So we make the net sales as the denominator. So when you look into fraction, okay, we put the net sales as the denominator and times 100. So we convert everything into percentage. So like for example, net sales is 100%, and we can look into how much of the cost of goods sold as a proportion of net sales. So like for example, maybe this year is 40%, next year is 50%. So at least we convert everything into percentage. We know that on average, how much is the cost of goods sold as a proportion of the net sales. That will give us a better picture to do comparison. So why am I talking about this? Because sometimes in midterms, they give you a scenario saying that, okay, now the company manager want to look into net sales, want to look into EBIT, and to do comparison across 5 years. So they give you 4 options, which statement that he should refer to. A, income statement, B, balance sheet, C, common size income statement, and D, common size balance sheet. A lot of students might choose income statement, but that's not the right answer because yes, it is income statement, but we need to convert everything into percentage when he wants to compare across 5 different years. So whenever you want to compare between different periods or even between different countries, the best way is to convert everything into percentage because when you put everything in values can be misleading because this year the net sales could be low and then the next year could be high. And every year the cost of goods sold are different. So therefore, sometimes the cost of goods sold can be very high, but we need to know how much is the cost of goods sold as a proportion of the net sales. That can give us a better picture. So we can convert everything to 100. We can convert everything into percentage. And net sales is 100%, and we can see how much is the cost of goods sold, how much is depreciation as a proportion of net sales. So when we convert everything to percentage, we call it as common size income statement or common size balance sheet. Okay, so that's the kind of question that you come across in your midterms. They give you a scenario and you choose what statement that the manager should use. All right. Now, once we understand the income statement, we have to understand balance sheet. So again, some basic accountings only, no worries. Okay, so this is balance sheet. What I need you to know is, again, the components. Okay, now before we look into components, this is what I say. You see, when they do comparison between 2007 and 2008 over here, you can see everything is value. So that's why I say value can be misleading. If it can be converted into percentage, that can give us a better picture. So this is why we usually use common size when you want to compare across different years. Okay, but it's okay. This is not our focus in this slide. This slide here, I want you to focus on the components. Now, remember in the previous class, I say that on your left-hand side is all about assets, and on the right-hand side is about liabilities and equities because we formed a formula in the previous class in which assets always equals to the liabilities plus the equities, right? So therefore, I can say that assets are being funded by liabilities and equities, which is the first formula that we formed in the previous class. So on my left-hand side over here is all about assets. Now, I need you to remember we have 2 types of assets. One is current asset. Current asset is for the short-term one, the liquid one, like for example, cash, inventory, the people that owe us money. These are what we call as current assets. And we have non-current asset as well. Non-current assets are for the long term, or we can call it as a fixed assets, okay, in which we can last for over the years, like for example, equipment, technology, machineries, buildings, and so on, right? So therefore, I can write over here, when you look into assets on my left column over here, we have current assets, okay, and non-current assets, in which we call as fixed assets here. So this is why when you look into current assets, you can see that we have the cash, accounts, receivables, and inventory. So the current assets here is this amount for 2007, and the non-current asset is this amount. So when you add it up, it becomes this amount for 2007. Same goes for 2008. You have this amount of current asset and this amount of fixed assets, and added up, you have these total assets. And on my right column over here, we have liabilities and equities. Now, when you look into liabilities, it can be divided into current liabilities and non-current liabilities as well. So current liabilities are like the short-term debts, okay? Like for example, we owe suppliers money, for instance. And long-term debts are like, for example, the loans that we take from the banks. So therefore, here we have current liabilities. And at the bottom over here, we have non-current liabilities. That means long-term debts. Okay, so now what happened is we have liabilities on the upper components, and at the bottom over here, we have what we call as equity. Okay, so you can see under equity over here, we have the common stock that we issue, okay, that we sell to the shareholders and also the retained earnings. Okay, so what you can see over here is here we have the total value of current assets, total value of non-current assets, and total value of equity. When we add it up, this is the amount in which it is equivalent to the total assets. So assets always equals to the liability plus equity. Same thing over here in 2008. This is the value for current assets. This is the value for non-current liabilities, current liabilities and non-current liabilities. And this is the value for equity. When we add it up, this is the amount in which it is equivalent to the total assets. Okay, so these are the basics that you need to know first in your balance sheet. Later, we are going to form a lot more formulas based on this original equation. Okay. Now, moving on, the next thing that you need to know is some theories. In the previous class, we say that there are two ways for a firm to raise finance. One is through the debt financing, in which they can sell it, they can sell the bonds or borrow money from banks. Another one is through equity financing, which we call it as the issue of shares. Now, here we need to look into the pros and cons of using debt financing and equity financing. So when we talk about debt financing, of course, the first thing is that it is cheaper. Why is that cheaper? Because when you were to compare with equity financing, it is more expensive. Equity financing means that you wanted to sell shares. You want to get your firms to be public listed first. Then only you can sell shares to the public. So whenever you want to go through all the process, remember we have to go through this thing called IPO, initial public offerings. So when you want to do all this, it's not cheap, it's expensive. So when you do comparison between debt financing and equity financing, of course, debt financing will be cheaper because you don't have to go through the IPO process. Okay. Second, we say that interest is an expense. So if it's an expense, it will reduce the amount of tax you have to pay because interest is tax deductible. It can reduce the amount of your tax that you have to pay at the end of the day. And the best thing is it does not dilute ownership because you're only using debts. You do not sell any shares, so you do not have to worry that someone will be buying so much of the shares and take over your company. So these are the pros of using debt financing. But what are the disadvantages? The main disadvantage is that it is contractual. That means it's something that you promise to pay. So in the event if you do not keep your promise, it will result in bankruptcy. Okay, so something like a responsibility to the firms. Now, what about equity financing? The good thing about equity financing is that it's not contractual. You only pay whenever the firm is making money. So therefore, there's no guarantee to pay. So it will not result in bankruptcy because it's not compulsory. You only pay the dividends, okay, whenever the firm is making money, right? What about the disadvantages? The bad thing is, first of all, you have to go through the IPO process that could be expensive as compared to debt financing. And then dividends is not an expense. Remember, we mentioned about that. Dividend, okay, is not contractual. It's not something that you have to pay every month or every year. So therefore, you cannot use it to reduce the amount of tax you have to pay. So it is not tax deductible. And the most important thing is it will dilute ownership. In the event if someone buys the most of the shares of a company, then the person will become the shareholder. Okay, so that's why the best part is if let's say you can remain at least 51% of the shares, then you can still remain the shareholders. But if not, you will have to worry that your ownership may be diluted. So these are the pros and cons of using different ways to raise finance. Now, what we are going to understand next are those formulas. So these are the formulas that are super duper important that will be assessed in your midterms. So just now, in the beginning of the class, we have just formed the first equation in which assets equals to liabilities plus equities, right? This is based on what we learned in the balance sheet. So on the left column is assets, on the right column is liabilities plus equity. So both values will be equivalent to each other. Now, I want to extend this formula to this one. So I want to see that the cash flow from assets, that means cash flow in the assets components, equals to the cash flow in liability and cash flow to equity. Now, we have three components over here. I label it as 1, 2, 3. And each component over here, we will have extensive formula that's very important. Okay, so therefore, before we look into the detailed formula, I want you to understand this simple formula over here first. Now, I want you to make it easier to understand for you. The first component means cash flow from asset means cash flow in your assets part. this second component, when they say cash flow from liability, I want you to change it. Instead of using the word from, you think about it as cash flow to liability. That means the cash flow, the cash that you use to pay for your creditors. Now, liability means what? Liability means we refer to the people that we owe money to, right? So therefore, this part, the second component means cash flow in liability. The cash flow in the liability part, that means that the cash that we need to use to pay for the people that we owe money to. Who are they? Creditors. So this second component over here means cash flow to the creditors. So later on, when we do calculation, you think about this. Second component means we calculate the cash to pay for creditors. Easier to understand already. Okay, let's do one more example. Cash flow from equity means cash flow in the equity component. So very hard to understand. Don't worry, we change the words. Don't use the word from. It's very confusing. Change the word to. That means the cash that I need to pay to who? The shareholders. Okay? Cash flow to equity. That means the cash that I need to pay for the shareholders. So when I do calculation, I will tell myself what I'm calculating. I'm calculating the cash that I need to pay for the shareholders or stockholders. Easier to understand. Okay, before we look into second and the third component, we zoom in to look into the first component over here first. How do we calculate the cash flow in the assets part? So now we zoom into the first component. You see, in the first formula, you have sub-formula as well. So that's why you have ample formulas that you're going to use for your midterms. So when you look into cash flow in the assets, we look into the components of operating cash. Now, what is operating cash? Operating cash means the cash on your hand, okay? We call it as operating cash flow, or short form called OCF. The cash that you have in your hand right now, okay, is part of your assets, right? So operating cash minus any net capital spending. What is net capital spending? That means we refer to the spending on the fixed assets. Like for example, machines, buildings, equipment, technologies. All these are what we call as net capital spending. So we use cash that we have on our hand, minus any net capital spending, and then minus any change in net working capital. What is net working capital? Working capital is the money that we use to pay for our day-to-day expenses that we learned in the previous class, right? So remember we said that when we look into working capital, we use current assets to minus current liabilities because we want to see how much of current assets do we have to pay back our current liabilities. So therefore, when we look into working capital, we look into current asset and current liabilities. So therefore, when I look into the cash in the asset component, I look into the cash that I have, operating cash, minus any net capital spending and minus any change in the net working capital. So that's our first formula. Usually this kind of formula will be provided. Maybe the sub-formulas will not be provided in your midterms. Now, I want to zoom in even more. Okay, I want to zoom in to see how do we calculate operating cash, how do we calculate net capital spending, and how do we calculate change in net working capital. Do you realize that we zoom in to see even more details right now? These are all the components you are going to calculate later on. So it's super important that you know what it means first. Okay, so the first one, I want to calculate my OCF, operating cash flow. Okay, how do we calculate operating cash flow? Remember income statement just now, we have EBIT, earning before interest and tax, EBIT in the income statement, right? Now, here we refer to the cash that we have, earning before interest and tax. Okay, now we need to add back the depreciation. Why? Because depreciation, yes, it is an expense, but do you really incur money for depreciation? No. That's why, although it's an expense, that's why we deduct depreciation just now, but it doesn't incur money. What? We put depreciation as an expense, but do you really incur money? No. So we can add that back. We still have the money on our hands. What? So we add back the depreciation, but do not forget, we definitely have to pay taxes. So we need to factor in that a portion of the money need to pay for taxes. We need to minus taxes. Now, students will ask the question, hey, how come interest not being deducted, man? Because when we say operating cash, that means we say the cash that we use to run our business, run our operations of the business that are linked to the sales of the goods and services. Interest is considered as non-operating expense because we use interest. Interest means what? Means the interest we pay for our loans. Maybe we borrow loans to finance the overall business, but it's not really linked to the sales of the goods and services. That's the thing. We use the loans, okay, to fund the overall business, to fund the buildings, but we do not link it to the sales of goods and services particularly. So it is considered as non-operating expense. But here I'm calculating operating cash. I want something that's linked to my business operations. So therefore, interest is not being factored in. We only factor in taxes. Okay, so this is why the formula only have these three components. Okay, okay, understand, right? Now, we look into the next one over here. How do we calculate net capital spending? We use the change in the fixed assets to see, let's say, for example, in the year, do we purchase any new assets, for instance, plus depreciation. Why we need to plus depreciation? Because fixed assets will depreciate across the years, across time. So we need to take that into account. And the last components over here, how do we calculate change in net working capital? Okay, so we use the ending net working capital minus beginning net working capital. But when you want to look into net working capital, we have to use the formula that we learned in the previous class, in which we use current assets minus current liabilities for the ending. And then same thing as well, use current asset minus current liabilities to find the beginning net working capital. So these are the formulas for one component only, cash flow in the assets. Okay, so what we're going to do next is to understand the second and the third components. So later we'll use questions to show you how this works, but at least these are the formulas you need to know first. Now, the second component is cash flow from liability. That's why I told you we change the words. We change the word to. Okay, so remember, cash flow to liability means the cash that I need to use to pay for the creditors, the people that we owe money to. So therefore, when we pay people, when we pay to the people that we owe money to, we have to pay interest, right? We borrow money, we have to pay back interest. So interest is something that I have to pay, minus any net new borrowing, because in that year, maybe instead of paying back, I borrow money some more. Okay, so therefore we need to look into any net new borrowing. Okay, so therefore, how the situation looks like. Example. Okay, now let's say I want to calculate cash flow to liability or cash flow in liability. Now let's say every month I have to pay this 100 of interest. Okay, and I have to put a minus sign because I follow the formula, minus any net new borrowing. Now let's say in this year, okay, in this month, for example, I pay back to the creditor 900. I pay back money. Okay, so if I pay back, I have to put a negative sign because I pay back cash going out. So I have to put negative here again. So negative 900. So do you realize that negative with negative, it becomes what? Positive. So this is why it total up. When we total up, it becomes a total amount that I pay to the creditors. Does it make sense right now? Right? So therefore, you can see when I pay back, I put a negative sign. When you have negative sign with the original equation, negative, negative, it becomes positive. So that means this month I pay a total of how much? 1,000. Okay. Now, if today I did not pay back, I go and borrow money some more, then we will not have this negative. It will become positive. So that means, yes, I pay 100 as an interest. Maybe at the same time, there are some money coming in as well. So I receive money as well from the liability. So this is why in different textbooks, sometimes we use the word cash flow from liability, cash flow to liability, or cash flow in liability. It doesn't matter as long as you know what it refers to. That means we're referring to the cash that we use to pay for our creditors. Okay. Same thing over here. We look into the third components, cash flow to equity. So that means to stockholders or to shareholders. Okay. What do we pay to the shareholders? Dividends. We pay dividends. Okay, now we pay dividends, but at the same time, in that year, maybe we raise new shares, new money coming in. So we minus any net new equity. Okay, so like for example, let's use another scenario. Let's say now I want to calculate cash flow to equity. Okay, so let's say in this particular year, I'm paying out, for example, for simplicity, 1,000 of the dividends. Okay, now let's say at the same time, okay, I'm raising new shares. and the shares, the money that coming in from the issue of new share is, for example, 500. So what does it mean here? That means I pay 1,000 in that year, but at the same time, I got 500 coming in. So at the end, in total, I actually have 500 net in cash flow coming in because I pay 1,000, okay, but 500 coming in over here. Okay, so therefore we have the 500 that's being paid out to the stockholders over here. Sorry, it's being paid out. Yeah. So because we pay out 1,000 as dividends, okay, minus 500 that I got from the issue of shares from the shareholders. Okay, so therefore I pay 1,000, I get in 500 coming in as a new shares. So therefore at the end in that year, the amount of money that I pay out is 500 in total. Cash flow to equity 500. Okay, so therefore these are the two formulas for the second and the third components. Okay, now later we are going to see one questions on this, a very long question. So when the question like this coming out in midterms, it will be like those long questions, okay, in which they ask you to calculate one component first and then followed by the others. Okay, now few terms that I want to go through with you before I look into tutorial questions. First of all, you need to understand the difference between market value and book value. So when we talk about market value means the value that's based on the market prices. When you want to sell an asset, okay, you sell at market value. That's what we call as the value based on the current market price. What is book value? Book value is a value that's based on your original value or the value that's stated on the balance sheet. So if the question mentioned that that's the value that's stated on balance sheet, that's what we call as book value. Okay, so the next one is you need to understand what is the difference between marginal tax rate and average tax rate, because there will also be one question to ask you to calculate average tax rate and marginal tax rate as well. So what is average tax rate? So average tax rate means that the total tax paid divided by the taxable income. That means on average, how much of the percent of tax being paid from my income. Okay, we will do a calculation later on. So for this one, it's more on calculation. Okay, and then marginal tax rate means the percentage of tax that I have to pay for the next dollar that I earn. So we'll use calculation to show this as well in a while. But at least I'm showing you one is average. That means when we look average means we have to do some division over here. We use the total tax divided by our income times 100. Okay, and then later on we'll calculate marginal tax rate as well in a while. Okay, so these are the contents you need to know first for now. Now, let's have a look into tutorial questions. I want to start with this question first. Okay, so let me erase all this. So these are one of the questions in your tutorial questions. We start with this one first. Okay, so first of all, I want to start with this question first because we talked about income statement just now. So I want to do this first. First of all, you can see the question over here. It says that given the following information for Suki's Cookies Corporate, calculate the depreciation expense. And they give you all the information in which you have the sales, you have the cost, you have the addition to retained earnings, you have the dividends, you have the interest expense and the tax rate. All the information are available. But the thing is what they want to calculate is the depreciation expense. So I will just use the template from the income statement just now and write this over here. And I wanted to calculate this one, depreciation expense. So the first step I can do is I can put up all the information that I have first. Right? So all the values that I put it over here in black color on the right hand side, the values that I put it here, the net sales, the cost of goods sold. Okay, this one is not available. Hold on, let me. So this one haven't calculated yet. Okay, and yeah, so these are the info that you have. Now, first of all, I can, for this question, because they want you to calculate depreciation, but you have so many missing information over here. The way for you to do this question is to do backwards. How do we do backwards? First of all, you see this question, you are being given with these two information, which is dividends paid and the addition to retained earnings. So in the beginning of the class, what is the first formula that I asked you to remember? Net income equals to dividends plus addition to retained earnings. The first formula that I asked you to remember in the beginning of the class, right? So therefore, now I have dividends and addition to retained earnings. I can put that into my template over here. Dividends is 955 and addition to retained earning is 2003. So when these two add up together, what did I get? Net income, right? So therefore, I can easily calculate my net income over here. So you add up together, what value do you get? So I add up, I will get 3,225. That's my net income. So this is why the tip for you to answer this question is you definitely have to do backwards because the information that I provide you is at the back. So now there is a problem because with this net income, you need to calculate back your taxes and your taxable income. How? We don't have any information at all. The only information that we have is only this 40% of the tax, which is 0.4. How do we calculate back all these values? This is a time where we have to use some maths, a bit like factorization. Okay, so how? So very simple. Okay, let's me show on whiteboard. Okay, how do we calculate net income from taxes? First of all, we have taxable income. Taxable income minus taxes, what we do get? Net income, correct? That's the first thing, correct or not? Based on the income statement. Okay, now I can rewrite it into how do we calculate taxes? We use taxable income times the taxes, right? So we use taxable income times the tax rate equals to the amount of tax they have to pay. Correct or not? Okay, so now we have to do some maths. Okay, taxable income minus taxable income times tax rate equals to my net income. So do you realize that I have two components here that's the same? So what can I do? I can use some maths over here to rewrite into like this. Okay, why am I able to write this? Because when you want to expand from here, you see taxable income times 1 equals to taxable income. Taxable income times tax rate equal to taxable income times tax rate. The next component over here, the maths. Okay, so that's why this is how I derive this equation. Okay, now I can start to pull out all the information that I have already because by using this formula, I can do all the calculations already. Okay, how? Let me show you. First of all, taxable income, I do not know. Okay, I do not know my taxable income. It remains as an unknown. But how much is my tax rate? 0.4. How much is my net income? 3,225. Awesome. So do you realize that I can do some calculations here already? Because I can move around to calculate my taxable income. So I can use 3,225 divided by 1 minus 0.4. And what answers did we get? So you see here, we can surely get taxable income already. So what's the value here? Five, 3,775. Awesome. That's taxable income. Now with taxable income, am I able to find out the actual value of taxes over here? Can correct or not? So therefore, I use another color pen. So how to calculate taxes? Okay, the amount of taxes, we use taxable income times the tax rate. Okay, so therefore, my taxable income is how much? 5,375 times my tax rate is 0.4. And at the end, what values did I get? 150. Okay, so these two are the information that you can already put it into your income statement, taxable income and the amount of tax. So let's see if we get it correctly or not. Let me check with the answer first. So yes, 5375 is the taxable income and 2150 is the taxes. So that means our workings are correct. So in case if you want to write down, I give it for a while. So these two are the information that you can already put into your income statement for you to be able to work backwards to calculate depreciation expense. Any questions so far before I move on? Okay, can. So now I can put all this into my income statement. Okay, so now I can just paste this into here. Okay, so now I have all these values. Okay, and I have interest payment based on the questions. So I can work backwards to calculate my EBIT. So can someone calculate for me how much is my EBIT over here? So I use 5,375, okay, plus back 1,230. That's where I get my EBIT. So how much is the value? You should be able to get 6,605. Okay, you add up 5,375 plus 1,230 equals to this amount. Now, we can answer the questions already. What is the depreciation expense? So I want you all to calculate how much is the depreciation expense then. So it's to calculate the middle value. Okay, you see net sales minus cost of goods sold minus depreciation equals to 6,605. So this is the EBIT. So I want to work backwards to calculate back the middle value. So can anyone tell me what is the final answers in this question? What's the answers? Five. Let's see if it's correct. I think yes, the answer is 4595. Yes, betul. Yep, so that's the answer. So we got the final values. That's the answer for this question. Any questions? So we have done with the first question over here for your tutorial questions. This is an easy one. Okay, now once you're done with this question, let's move on to the next question. Okay, next question, I do not want you to pay too much of attention. I just want you to understand what components you have. Let's do this question first. Now, prepare a balance sheet. So, so you have the balance sheet for this company as of December 31st, 2010, based on the following information. You have the cash, you have the patents and copyrights, you have accounts payable, you have accounts receivable, you have tangible net fixed assets, inventory, notes payable, accumulated retained earnings, and long-term debts. They want you to form a balance sheet. So very simple. This one, you just use the template and fill up the details, fill up the values. Okay, what I want to focus on is this. You see here, on my balance sheet, we have current asset, this amount, and also the fixed assets. Okay, so we have the tangible net fixed asset, which is this amount, and intangible net fixed asset, this amount. So we add up all these together, okay, we will get these total assets. Same thing over here for my liabilities. I have my current liabilities here and also long-term liabilities here. So added up, it becomes total liabilities. Okay. And for the shareholders part, the equity part is incomplete. There is missing value over here. But we have the rest of information. So same thing over here, we need to calculate something what we call as the middle value. So we know the final value is the same as the asset, which is this amount. So I have to use this amount minus the accumulated of retained earnings and minus the total liabilities in order for me to calculate this missing value. So therefore, to calculate this missing value, I can use this formula. I use the total liabilities minus any accumulated retained earnings minus the total liabilities over here. Okay, the total liabilities and equity minus accumulated retained earnings and minus total liabilities to calculate the missing values. So a bit like you work backwards to find the missing value over here. Okay, now this one I don't want you to pay too much of attention to it. I want to look into the rest of the tutorial questions. Okay, now let's have a look into your tutorial questions. Okay, first question. First question is to ask you to calculate market value and book value. So Cochlear Incorporated purchased new cloaking machinery 3 years ago for 4 million. The machinery can be sold to the Romulans today for 6.2 million. So can someone tell me what value is this? You sell the item based on the market prices, market value. Okay. Cochlear's current balance sheet shows net fixed assets of 2.8 million. What value is this? Book value. Okay. Current liabilities of 710,000 and net working capital of 130,000. There is one thing, they do not provide you current asset. So we have to calculate later on. It's okay, never mind, we'll come to this in a while. Okay, if all the current assets were liquidated today, the company will receive 825,000 million in cash. What value is this? Market value. Okay, so what they're asking you to calculate is, what is the book value of the assets and what is the market value of the assets? Okay, first question. What are the two types of assets we have? In the beginning of the class, we just mentioned it. Current and? Very good. So we use that to develop our answers. You see how easy it can be, huh? Okay. You see, they ask you to calculate book value. Okay, everyone follow these methods. It's going to be very easy. Book value of assets and market value of assets. Okay, although it seems like a lot of calculations, but we use back what we learned in the beginning of the class. Things will be way easier already. Okay, they ask you to calculate book value of assets and market value of assets. Now, the first thing, you just answer the question very good. You say that assets, we have current assets and non-current assets. We write that first. So we want to find out the current value of the book value of the current assets and the book value of the non-current assets. When I say non-current assets, it means fixed assets. I believe you all know this already. Very good. Okay, so we have to find out the book value for these two components, and at the same time we want to find the market value of these two components. So what we need to do now is to fill up the data. Okay, because we want to calculate the final value, the total value basically. So you see, we do step by step. Things will be easier because you know that assets got two types. So later on, we just fill up the data one by one. Then we are done. Okay, so just now, we see that they want to sell the machinery to Romulan for 6.2 million. This is market value. Okay, market value. Market value of the assets over here. Okay, machinery, current or non-current? Non-current, very good. So we fill it up here first. Awesome. Okay, so we can fill up over here. This is the 6.2 million. Okay. Next, Qualcomm's current balance sheet shows the net fixed assets of 2.8 million. 2.8 million net fixed assets. Net fixed assets means fixed assets, no? Book value, because it's balance sheet. So, right here. Okay. But there's a problem. I do not have the book value of the current asset. How do I get? I have the current liabilities. I have the net working capital for the book value. So am I able to do that to calculate my current asset? I can. How? What's the formula that I mentioned in the beginning of the class? Net working capital is equals to current asset minus current liabilities. Awesome. Okay. So therefore, current asset is unknown. But we know net working capital is how much? Net working capital is 130,000. Okay. Equals to current asset minus current liabilities. Current liability is 710. Okay, then we can get the current asset ready. Easy. $840,000. So what value is it? Book value, because it's in the balance sheet. Okay, so we put that in over here. 840,000. Okay, so for book value of asset, we can calculate already. Easy. So we add up. How much is the value? 3,640,000. Okay, we counting with the book value of assets already. Now we need to counting for the market value of assets. So how much the current asset for how much the market value for the current assets? Here, 825,000. So you see, we use back all the formulas from the beginning of the class. 825,000. So now, same thing, we can form the final answers. How much is the answer? 7,025,000. Okay, we are done with the first question already. So what is the purpose of this first question? Is for you to identify which one is book value, which one is market value, and you need to know that for assets, we have current asset and non-current assets. That's why you see, once you understand the income statement and balance sheet, things are easy, right? Okay, so that's the first question over here. Once you are done with first question, I want to focus on second question. Second question is you will have at least one in your midterm. So try to do second question first, because you will have at least one question to calculate average tax rate and one question on marginal tax rate in your midterm. So 2 questions in your next question there. Okay, once you write down the first question, have a look into your second question. Okay, now let's have a look into the next question. Wait, anyone need more time for the first question? Okay, then move on. Okay, now, second question. The SGS company had 274,000 in taxable income. Using the rates from table 2.3, calculate the company's income taxes. Okay, so how do we understand this tax rate? Now, next time when you want to pay your tax, this is the tax rate that you have to follow as well. But this is corporate tax rate. You have personal tax rate. Okay, you see, first 50,000 subject to 15% of tax rate. Now, the next 25,000, now for simplicity, we assume from 50,000 to 75,000. Okay, because if you want to really minus with 50,001, you will get a lot of values with 99999. So it's very hard to calculate. So we assume it's from 50,000 to 75,000. So the next 25,000 over here, subject to 25% of tax. The next 25,000 over here, subject to 34% of tax. Okay, now my question for you is this. If the company is earning 274,000, right, which category it belongs to? First, you identify which category it belongs to first. Where? 39%. Awesome. So at least you know that it belongs somewhere here. Okay, so this is good. At least later when you calculate marginal tax rate, it's very easy to find the answers already. Okay, now, so very simple already. The first 50,000, you will times it with 0.15. Okay, so as you can see over here, 0.15 times 50,000. So the first 50,000 is subject to 15% of the tax. The next 25,000 over here, subject to 25% of the tax. Okay, and then moving on, the next 25,000 over here, subject to 34% of the tax, which I can write over here. And lastly, because we know it's somewhere over here, right? We want to calculate the actual residual value. Okay, we want to calculate the exact value here. We know that it belongs to this category, but how much is the exact residual value? So we know the company is earning 274,000 minus the 100,000. So that means the leftover value that's subject to 39% of tax is this amount. How much is this amount? So you use 274,000 minus 100,000. So you get 174,000. So you use 174,000 times the tax rate, 0.39. That's what it means by this part over here. That means you find out the residual value, the leftover value that's subject to the 39% of the tax. And at the end, I get a total tax of 90,110. 110. That means this is the total tax they have to pay. But the question is asking how to calculate average tax rate. So what is the formula that we learned just now in the class? Okay, we use the taxes that we pay divided by the income that you earn. The taxes that you pay is 90,110. The income that you earn in total is 274,000. So divide it times 100, you get this amount, 32.8%. Quite high, huh? Quite high. Okay, hope it's not like this in real life. Quite high. Okay, so that's the average tax rate. But how do you get your marginal tax rate? Marginal tax rate, you don't have to do any calculation. What is marginal tax rate? Marginal tax rate means the tax rate that you subject to for the next dollar that you earn. Now you are earning 274,000. The next dollar that you earn, is it still in the same category? Hey, see properly? Is it still in the same category? So for the next dollar, let's say 274,001, is it still belong to the same category over here? Yes. So the next dollar that you earn, it will subject to 39% of the tax. So you get 39 over here. You have one question to calculate average tax rate, and you have one question for marginal tax rate in your midterm. Okay? Any questions so far? Before we move on to one long question for the next one. So can everyone get the answers for this one? We do not like anything yeah. Oh, good, huh? Before good, then we're going to look at the next question on the use of the formulas that we learned in the beginning of the class. Okay, now, next question here. So again, they give you a lot of information. So Sheffield Company shows the following information on its 2010 income statement. You have the sales, you have the cost, other expenses, depreciation expenses, interest expense, taxes, dividends. And they say that you are told that the firm issue 2006 in new equity, new shares coming in. Okay, I mean new shares being issued, money coming in, and redeem 3,900 in outstanding long-term debt. What do you mean by redeem debt? Very important keywords. Redeem debts means you reduce your debts. That means you pay back your debts. Please write it down. Redeem debts means you reduce your debts. That means you pay back your debts. I repeat, redeem debts means your debt is reduced. You reduce your debts. That means you pay back your debts. So if you pay back your debts, your value will have positive or negative sign. Wait, payback war negative, yeah. Negative, they only become positive. But first you have negative. Later on, we need to add on the negative in this 3009. Tricky, yeah? This is how midterm question looks like. Okay? First question A. What is the OCF, operating cash flow? Wow, so we have to use the DKIR formula. What is the formula of operating cash flow? You go back to our slides and I need to use this formula, operating cash flow. So to calculate operating cash flow, I need to use EBIT plus depreciation and minus taxes. Okay, but the problem is we do not have EBIT. So again, we have to do from scratch. We do not have complete information. We have a lot of missing information. What should we do? Again, we have to do backwards. So do you realize that how many steps we have? A lot. Okay, so therefore, we do it step by step. First, we fill up all the information that we have first. Okay, so therefore, we have the sales value, we fill this up. We have the cost value, we fill this up. We have other expenses, we fill this up. We have depreciation, we fill this up. Why am I filling this up? To calculate EBIT. Without EBIT, I cannot do anything at all. Okay, so sales minus cost of goods sold minus other expenses minus depreciation, I get my EBIT in the end. Now, of course, I can make my income statement to be complete. Okay, so I can fill up the interest expense because they provide interest expense, which is 8,400. Okay, 8,400. Minus interest expense, I get taxable income, and then minus the amount of taxes they provide already. So at the end, I get net income. So if let's say today I ask you to calculate addition to retained earnings, also cannot, because I know dividends that I pay out is 7,002 already. So whatever I left over is the addition to retained earnings. So if let's say they want us to calculate addition to retained earnings, very simple. We use net income minus net income equals to dividends plus addition to retained earnings. Right? So now we have the net income already. Okay, so net income is this amount equals to dividends that we pay out is 7,200. And addition of retained earnings, I do not know. So I can move around with the numbers and calculate the value. Okay, so at the end, you move around, minus each other, and you get 23,070. That is your addition to retained earnings. That's for information. But this is not my focus yet, because my focus is to calculate my OCF. So how do we calculate OCF? So we use back the formula. OCF equals to EBIT plus depreciation, right? Because I told you already, depreciation is a expense that does not incur money, so we can add that back. Minus taxation, because we need to factor in the tax we pay. Okay, let's see what value did we get then. EBIT is, first now we calculate already, 55,000 plus depreciation. How much is the depreciation that we see from the questions? 10,900 and minus the amount of taxes. How much is the taxes that I'm paying? 16,330. Where do I get this number? From the question as well. From the question. Okay, so now I can get my OCF. So someone give me the value. 49570. Terima kasih. Okay, so that's the answers for the first question. A, OCF. Oh, good. Okay. Last time you used to do all the tutorial questions before a class, right? So how this time you do or not? Okay, okay, great. That's good. Good enough. As long as you try first, then at least you have the thinking process going on. So you know already these are the these are the midterm type questions. Then it's good. Good that you take it as a practice. So yeah. Yes. How do I get EBIT? I minus off this one, minus this one, minus this one, minus this one. I get this 55,000. Minus from this one. 153 minus this one, minus this one, minus this one.
Just now the question
Because for simplicity, I use this one minus this one is how much? 19,999. Very hard for us to calculate. So we round off lah. So we just assume this is zero. Easier for us to calculate. So we assume this 50,000. This 75,000. This minus 75,000. Not average, like we round off this one. We round off this one. So this one we assume this is 50,000. So from 50,000 to 75,000 is 35,000. So this amount over here, subject to this amount tax. You can think about like it's the first 50,000 that pay this amount. The next 25,000 pay this amount. Next 25,000 pay this amount. The rest is the continue. Okay, this one. No, you use calculator. You use 55 minus this amount. What the calculator? It should be 135,000。对呀，减的值啊。所以如果你到这边的话，这边就不是25,000了，这边就是231,000，少最多39%的 tax。然后再接下来通常我们会放比较容易算，你放1的话，你这样的 number 会9999难算。其实你就算算的话，你答案很接近了，你答案也是差不多，也是那个 percentage。Okay, let's continue. Okay, next question. What is the 2019 cash flow to creditors? Okay, first, again, it's all about formulas, right? Cash flow to creditors. Creditors means liabilities. That means the money that we pay to the people that we owe money to. So what's the formula? We take into account interest minus any net new borrowing. Now, you all just now answer a very good question already, because we say that they pay back the debts, so it will be a negative sign. So interest payment is how much? 8,004. Okay, that we took from the question. Minus, because we pay back the money. How much we pay back? 3,009. Right? We pay back 3,009, right? Okay, so you see got minus, minus. So when you have two negative, it becomes positive. Awesome. So that's why when you add this up together, this is the total amount that you pay to your creditors. Then now it makes sense to you already, because you pay 8,400, which is the interest, plus you pay back the debts, which is 3,009. So negative, positive. So total amount that you pay is 12,300. Done. Question B done. See, so this kind of question come out in midterms, easy, right? So it will be extensive questions. After you answer the first question, followed by second question, third question, fourth question. So you see, when you calculate cash flow to creditors, it's easy for you already. So continue. If I want to calculate the next question, what is the 2010 cash flow to stockholders? Same thing, cash flow to stockholders means to equity. Okay. So we use the formula dividends. We pay dividends minus what? Minus any net new equity. So did they raise any new shares? Yes, no? So first of all, dividends is 7,200 from the question. And they did raise new shares. How much they raise from the question? How much? Rapper? How much is the number that, how much is the value that they raise in terms of the shares? 2,600. Thank you. Okay, then at the end, we get back the final answers, which is 4,006. Ta-da! We are done with question C. B and C are easier because you just use the second and the third component. Yes. Then we reduce that one. You pay back the debt of the customer. So that you did not borrow money to pay back money. Oh. Oh. Okay, then next question will be more difficult one. Okay, so next question, let's try it and see if you can get the answers or not. Okay, now let's move on to the most difficult one, this one. Question D. If the net fixed assets increased by this amount, 19,475 during this year, what was the addition to the net working capital? Okay, so first of all, they want us to calculate net working capital. So remember, where do we get the change in net working capital in our statement, in our formula? This one. Change in net working capital is the third component over here. Wow, so we are going to do a lot of calculation for each component one by one to get the final answers on the change in net working capital. Okay, so now we have to do it step by step. Okay, so first of all, we are going to use this formula. Okay, so now we have to do step by step here. Let's do it on whiteboard. Okay. First of all, this is the formula that we must use because we want to calculate the change in net working capital. Okay, but the first thing, I want to calculate my first component here first, cash flow from assets. Remember we learned that there are different formulas for us to calculate cash flow from assets. So it depends on what data or what value do we have to determine which formula that we need to use. Now remember we say that there's this formula that we learn, cash flow from assets equals to cash flow to liability plus cash flow to equity. Remember this one? So remember we just calculate question B and C that we have the value of cash flow to liability and equities. So what's the value? Cash flow to liability. 12,300 and 4,006, right? So 12,300 and 4,006. So in the end, how much is my cash flow from assets? So I add up together is 16,900. Okay, now the first information I got already. Yeah. Okay, so the first one I have here already. So I can rewrite my formula here. Okay, now I know my cash flow from asset is 16,900 equals to operating cash flow is OCF. Remember, we just calculate in the beginning of the class as well. Okay, later we put that in. And net capital spending. Now, what is the formula for net capital spending? Okay, I write here first, net capital spending, and then change in net working capital. Okay, so I can expand the formula. OCF minus net capital spending. What's the formula? Correct. Change in fixed assets. Then plus. Very good. Thank you so much. So do you realize that we have all this value right now? We can calculate one by one already. So 16,900, I got it ready. And how much is my OCF? So we go back to the question A, 49,570. Okay. Change in the operating cash flow we got ready. Very good. Now I want to calculate net capital spending. How much is my net capital spending? Okay, so how much is the new assets being bought in? So we look back the questions. 19475 here, right? How much is the depreciation? 10,900. Okay, so I add up these two together. Okay. Change in fixed assets. You have new assets coming in, 19,475 plus depreciation. How much already depreciation? Sorry, 10. Okay, thank you so much. Okay, then we can calculate change in net working capital. So everyone can do this already and let me know what is your final values. We can finish this question, then we can call it a day. So if you find that very complicated, do step by step first. Okay. So today's formula is still considered as easy one. Next week, we'll have more new formulas on ratios. Okay, so make sure you master this first. So quite fun, right? Finance. So we calculate, put that into calculator, 49570 minus 30375 minus 16,900 equals to 2295. Let's see if the answer is correct. Yes, 2295 is the final answers. 2295. So therefore, the answer for this question is this one, because they asked us to calculate the change in net working capital. So they asked us to calculate this one, change in net working capital. So in order for us to do that, we get the values for each of the components, and at the end, we get the final answers. So here, now we get the final answers here. Got meaning one. Positive, negative, that it means different things. Why you get negative? So it does have meanings one. Yeah, so yeah. Sorry? Yeah, net capital spending, the formula is this one, change in fixed assets plus depreciation. This one over here. I put it here already. Okay. So these are the tutorial questions for your topic 2.